Hello, and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today is June 19th, 2021. It is 2:58 p.m. Eastern Standard Time. Today, I want to talk about the Federal Reserve and market expectations. Earlier this week, we had the Fed make an announcement that sometime in the next 2 years they're going to start unwinding monetary policy. Now, the last time they attempted to do something to this extent, there was the infamous taper tantrum, where at the first sign of the Federal Reserve attempting to raise short-term interest rates, the financial markets responded aggressively, and you had a sell-off in stocks as well as bonds. Now, when you think about how these markets work, it's understandable that market participants, upon hearing that the central bank, which has been providing trillions of dollars of monetary accommodation, is now considering unwinding. So given what we've heard from the Fed in recent days about beginning the conversation about tapering off monetary accommodation and eventually tightening monetary policy, market participants are reacting somewhat according to expectations. What I mean when I say this is that stock markets have been trending higher in part due to low interest rates and ultra accommodative monetary policy. So it stands to reason that once you start to remove that accommodation, the opposite effect should occur. So you should see valuations falling in equities market. Market participants are adjusting their expectations for future growth, future profitability, because basically the cost of money is about to start increasing. And that's relevant when you have an economy that's ran on borrowed money. Even in the equity pricing models where you're looking to discount future cash flows, the market rate or the interest rate at which those future cash flows are discounted is now increasing. You get lower present value as interest rates start rising. And if it's a trend, a rising trend, it should have a direct dampening effect on equity markets and share prices. A similar effect will be seen in real estate because you have so many transactions, especially in the housing market, funded with mortgages. And the amount that an individual can borrow is directly tied to the level of interest rates. As interest rates rise, borrowers can borrow less and less money, then there's less of a chance or an opportunity to bid up the price of real estate because you just don't have the borrowing ability to transact at higher and higher prices. Bond investors are in a precarious position because of the inverse relationship between interest rates and bond prices. On one hand, if you're short term, more of a bond trader, it's all good and well. You're more than likely able to play these things in both directions. And if not, you have the opportunity to time entry and exit into the market on what would otherwise be pullbacks, I guess. Even though that's the risk reward ratios on those types of trades are a little bit lopsided. But if your timing is good, if your technical analysis is good, more power to you. From a bond investor standpoint, they would be more interested in selling their longer dated instruments and shifting some of that money towards the front end of the yield curve and buying shorter dated instruments, especially if we get into a rate rising cycle and not just a one-off increase in short-term interest rates. And the whole objective of that would simply be to be able to reinvest quicker. So you buy shorter duration notes, bills, and as they mature quicker, you can then reinvest at a presumably higher interest rate in the near future and keep reinvesting at presumably higher interest rates in the near future on a rolling basis going forward as interest rates keep rising, versus locking in a relatively low yield for a longer period and waiting the duration until you can reinvest again. In the meantime, I think that's the risk you face by holding longer dated fixed income instruments versus shifting more towards the front end of the curve and being able to reinvest quicker with shorter dated instruments. So looking at the bond market, if we do get into a rate rising cycle, or even just the beginnings of a tapering where the Fed is still purchasing trillions of dollars of instruments, but maybe they're just not reinvesting the proceeds from those, or maybe they're starting to reduce the amount that they're buying per month, but they're still buying tens of billions of dollars of instruments per month. Maybe it's just a couple billion less and then a couple billion less. Before you know it, they're down to 1 or 2 billion per month. And then past there, if the underlying economic environment can support that, then we may actually move into a rate rising cycle as the accommodation, the quantitative easing is taken off the table, and then we move into an actual tightening cycle. But we will get to see in this instance how close the Federal Reserve is, if at all, to being in a liquidity trap. If they can tighten monetary policy and not generate a recession, then it can be accepted that the Fed escaped the risk of a Japan-style liquidity trap. If they cannot tighten monetary policy without generating a recession, then the train of thought needs to now shift going forward, because we would know that the Federal Reserve is stuck in basically a deflationary cycle, and they can't generate inflation through ultra accommodative monetary policy. So the only thing they can do is keep monetary policy ultra accommodative, because if they try to tighten, they're just going to create a recession. Hence the liquidity trap. The central bank is trapped providing liquidity. Anything else, and it just generates a recession because the economy cannot function without it. So basically, investors are in a position to have to readjust their expectations in response to the change in monetary policy. And this is an opportunity for the Federal Reserve as a central bank to demonstrate that it can escape a liquidity trap. To their advantage, the federal government is committing trillions of dollars of fiscal stimulus. So the question now becomes, is the fiscal commitment enough to stimulate inflation and economic growth so that the Federal Reserve can slowly unwind monetary policy that they had to institute as a response to the great financial crisis? As a note, for them to accomplish this, we will need persistently high inflation. My question is, with the proliferation of artificial intelligence, robotics, will wages be able to keep up with that persistent inflation that is needed for the Federal Reserve to pull off its greatest trick ever? We'll jump to the trade book. So last week was a little bit light on trading. There are a couple other things that had my attention, so I didn't really commit to a range of positions. I did trade options on oil, gold, and the S&P through the USO, GLD, and SPY ETFs. And then, of course, a small position of BLOK, which is an ETF that tracks blockchain, just as a way to get some exposure to that segment of the financial market. With the blockchain position, because I have no clear concept of a time frame for this thing, I'm choosing to just hold an equity position because I don't have to factor in time as a variable. In other words, I can hold it indefinitely because I have no clear concept of when or how this thing is going to move, but I do know that it's a technology that is here to stay in one form or another. With USO tracking oil, the previous week I was looking at oil as a low volatility play because it had been just that, very slow moving. So I sold an iron condor around the price was for USO at the time. And for the most part, the price bounced around within the range. I think at one point it may have broken into the call vertical on the upside. But I was able to close out the position day before expiration because it was looking kind of weird. But I was able to close it out profitably. I looked at the oil chart and I saw the kind of volatility that was building up from the previous week. It was trending pretty consistently on multiple time frames. 1 day, 1 week, 1 month, 1 quarter. It was all pushing higher. So it was trending and it had the momentum behind it. So, okay, I look at it going into this week that just ended with the expectation that there's going to be an increase in volatility, and volatility for me in terms of futures doesn't always mean price down. Volatility is just a higher standard deviation, positive or negative. So when I refer to volatility, I'm referring to how far the price can move higher or lower, versus more commonly when it's referred to in stocks, volatility only implies the price falling. So going into the trading week that just ended, I was looking at the oil market as having the potential to see a spike in price, but it was already trending higher and had momentum behind it. So the expectation was that the price would spike, volatility would increase, but it would move the price higher. So instead of taking a low volatility play by selling an iron condor, but with the trend that I witnessed on different time frames with oil, I decided just to do a call vertical, and it was a good trade all the way up until day of expiration. At one point, the price was flirting with the upper limit on the call vertical. And overnight, going into expiration day, the price drops out the bottom of the vertical and falls out of the money. Early morning session on Friday, oil gets a bit of a bounce and it creeps back into the money, relatively close to my break even, but I had nothing to convince me that there was going to be some last minute push higher in oil prices. So I had to salvage what I could in premiums from that trade. My position on gold was a profitable one this week. I've been looking at the relationship between gold and the dollar, and the dollar has been forecasting a move higher despite the consensus that the dollar should be moving lower. The chart was telling me otherwise. And in previous weeks, as the dollar consolidated in longer term time frames, I was able to play in the currency futures markets that sideways movement profitably. I had no exposure to the long dollar move. Typically, long dollar would be my baseline position, and when reversal patterns show up, I would execute a hedge or a calendar spread. But there's always next week. And the pattern that's playing out is one that's developing on a longer term chart, so it's not like the trade's going to be over in the next couple of days. So, looking at what the dollar was signaling and the correlation relationship between gold and the dollar, I was confident in a short gold position, which I was able to close out in the money day before expiration. SPY positioning, that one netted a small loss this week. I had Wednesday expiration and Friday expiration. On my Wednesday expiration, I initiated a put vertical again because of a correlation relationship between gold and stocks, and I had enough signals pointing to a short gold, so that hinted to me that stocks may also be facing some negative price action. So with that in mind, I initiated a put vertical on the SPY on Monday with the Wednesday expiration. On Tuesday, because of the way the price traded on Monday and for the first half of Tuesday, I turned my put vertical into a straddle. With the market move late Wednesday, the price shot through the put vertical and that one closed in the money. So that was another example of trusting my instincts, because I saw the cross market correlated signals and I saw the chart pattern and candle pattern signals on the SPY. I initiated the put vertical, but I started second guessing myself based on price action Monday and price action early Tuesday. Put on a hedge, and I could have made 3 times as much on the trade if I was not hedged, basically. I still had a net short exposure, but based on how the price was trading, I felt that I ran the risk of having the price close at the money or out of the money on the put, and would require some kind of an offset for the premiums that I paid. Then on Thursday, looking at the Friday expiration, I got caught up in a dead cat bounce and went long with an anticipation of the S&P rebounding overnight and into the Friday session in New York, but it did not. So lost the premiums that I paid on Thursday, closed out on Friday. That one expired out of the money on Friday, and lost those premiums. I haven't done the accounting yet to get to the specific number, but unofficially I did lose a small amount on the S&P trading options this week. USO, I lost a small amount as well because of a last minute turn in the market. I saw it the day before expiration, thought the market could hold out one more day. It could not. Went from a winning trade to a losing trade. And then the blockchain position increased a little in value, but it is still down relative to where I bought in on the position. So it's just sitting off in the background. It does make a good placeholder though for margin, because I am trading on a margin account. So having an equity position does create margin that I can then use to trade options with, trade futures. This week I tried to pair the dashboard signals with a multiple time frame view of the instruments that I look at on the dashboard. As a reminder, the time frame on the dashboard is 5 days worth of data, 2-hour candles. The dashboard is more geared towards looking for reversals. So the goal of the indicators that I look at on the dashboard are to highlight to me when something is changing. When the market is trending and everything's moving in one direction, that's fine. It's an easy trade. The trend is your friend. But as a swing trader, I can zoom in to a week's worth of data and try to look for signs that something is breaking down, there's some kind of a directional shift occurring, and from there I try to confirm on other time frames what I think I'm seeing on the dashboard, and then I try to build a trading strategy around that. Try to figure out what the overall financial market should be doing within the next few trading sessions. And from there, figure out how do I get exposure to what I think is going to happen in financial markets. So which instruments, what strategies, am I using options and equities, am I using futures, am I using options and futures? And one of the multiple time frame glances or views that I like to take is comparing 1 day's worth of data, 1 week's worth of data, 1 month worth of data, and 1 quarter worth of data. And like I mentioned with the oil market in the previous section, in addition to looking at the dashboard, I looked at 4 time frames and their regressions, and they were all 4 pointing in the same direction. Now, that tells me what the price has been doing. If there isn't anything on the dashboard that's signaling a change or a break or a deviation that's occurring, then more than likely the price is going to keep doing that. And then, of course, from there, I know which instruments I want to look at, which markets I want to look at, and how I want to assume my risk. So, looking at the dollar is oscillating around its regression curve ribbon, but the ribbon is trending at a 45-degree angle upwards. The pivot indicator is signaling support, and my regression slope indicator signaling momentum is positive, but it is getting less positive. My linear regression slope signaling trend, it's positive and it's getting more positive. So we have price trending higher. It's following its regression curve ribbon. It has support from its pivot indicator. It is losing a little bit of momentum, but it is still positive. So the dashboard is signaling a consolidation with an upward bias in the dollar. But again, that's looking at 5 days worth of data. So that can only take you out 2, maybe 3 days of forecasting. Crude oil is showing a little bit of a different picture. For most of the previous week, and I think maybe even a week before that, crude oil and the dollar exhibiting a bit of a correlated relationship, wherein they were both gently trending higher. The dollar accelerated last week higher. We saw the reverberations in other markets like gold and 10-year treasury, even the stock market, but not so much in crude oil. So instead of maintaining that relationship with the dollar moving higher as well, over the last week, crude oil started trending lower. So its regression curve ribbon is trending lower. Crude oil is oscillating around that ribbon. Its pivot indicator is signaling resistance. The linear regression slope measuring momentum is negative. It is getting less negative, however, but I think that also reflects the price being above its regression curve ribbon as it oscillates around it. And the linear regression slope measuring the trend is negative and getting more negative. So definitely from a trending standpoint, crude oil has turned. Trend went from positive to negative. It's lost a lot of momentum in the past couple trading sessions, and its pivot indicator is signaling resistance. Looking at the dashboard alone, it does seem like crude oil is poised to turn lower. Because it's above its regression curve ribbon, we could see some consolidation, which could present an opportunity for traders that know how to capitalize on sideways price movement. But inevitably, it looks like the price is setting up to make lower highs and lower lows, which highlight a downward trend. Then we'll look at gold. For the entire week, gold has been trending lower. So its regression curve ribbon is sloping down at a 45-degree angle, and it is oscillating around the ribbon. Its pivot indicator for the first half of the week was oscillating between support and resistance, but with the move late Wednesday into Thursday, the pivot indicator is showing resistance. The linear regression slope measuring momentum went negative during the late Wednesday into mid Thursday session, and then started moving less negative into Friday. At the close of Friday, momentum was at the zero line. So from that indicator alone, we could see some consolidation and maybe the beginning of a reversal in gold. The linear regression slope indicating trend, however, has been negative all week and has gotten even more negative with the move we saw that begun on the mid-Wednesday session and continued throughout the end of the week. So the momentum needs to go positive first and decidedly positive. The trend will inevitably follow. The price can accelerate higher above its regression curve ribbon and break through its pivot indicator, switching it from resistance to support. In order for gold to do that, it will take a significant move higher. So the dashboard is signaling the beginning of a breakdown, but this one definitely warrants patience for confirmation. So the indicators are all pointing in one direction. So even though there's a break in one or two of the indicators, there could still be room for the price to keep moving because of how strong the trend is. While the other indicators slowly get in line with the ones that are breaking, and then you have some critical mass of change that then affects the overall direction of the price. Gold doesn't seem like it's at that point of critical mass yet, so on the riskier side, you can keep trading it lower. On the safer side, you can just wait for confirmation on a reversal, which will more than likely mean, however, that you will miss a substantial part of the initial move waiting for confirmation. But if it's more of a macro trend that's playing out, there'll always be more opportunities to make money from it. Looking at the S&P, this one's telling a clear story. The linear regression ribbon is oscillating lower, and the price is oscillating around it. The pivot indicator is clearly signaling resistance. The linear regression slope measuring momentum is negative and getting more negative, as well as the linear regression slope measuring trend is negative and getting more negative. The price, while oscillating around its regression curve ribbon in the last few hours of the session, have been accelerating lower. So the dashboard is signaling a short on the S&P. Now this is where your longer term charts would come in for context, because then you can look at long term support and resistance levels, and those can be your targets when markets are just trending like this. So you find a trending market, you look for a long term support resistance level, set your targets. If you have a market that's trending and then you start seeing indicators start breaking ranks or they start diverging, then you know something's happening, there's a change happening, something's breaking down. If the price is close to a long-term support resistance level, that could be it, which helps you narrow down the price range that you can trade. And then also helps you with, your breakouts and reversals. But from the dashboard standpoint, next few trading sessions, S&P 500 looks like a short. When it comes to the 10-year treasury, it looks like that relationship it had developed with the S&P 500 might be breaking, because after the Wednesday announcement by the Federal Reserve, I noticed a bit of a divergence in the price with the S&P 500 and the 10-year treasury. It seems like the 10-year treasury reversed and moved higher from the initial drop in price from the Fed announcement on Wednesday, while the S&P 500 kept moving lower. That's more like that negatively correlated relationship that an entire generation of money managers built their portfolio strategies around. From the dashboard standpoint, the regression curve ribbon is pointing lower, but the price is accelerating above the ribbon, while the ribbon seems to be putting in a sideways leg. So we could be looking at a reversal if the price continues to use the ribbon as support and accelerate higher. The pivot indicator switched from resistance to support, which is also signaling a move higher in price. The linear regression slope measuring momentum, it's positive. Not very positive. It doesn't seem to be accelerating higher, but it is positive. The linear regression slope measuring trend, however, is negative, but it is worth mentioning that since early Thursday, the trend has been getting less negative. So from the information I can gather on the dashboard, the 10-year treasury actually looks like it's setting up a buy. So while we're seeing the S&P 500 looking like it's pushing lower, the 10-year treasury is looking like it is turning higher. So going into this upcoming week, looking at oil, I will probably once again be using the USO ETF to play my oil exposure. And this time around, however, I think I might be setting up a put vertical because of what I'm seeing with crude oil on the dashboard. If the trend continues lower on crude oil and the momentum stays negative, a chart pattern may develop that can signal a breakout lower in crude oil, which I can play with a put vertical on USL. With the S&P 500, I'm once again looking at the SPY ETF. I will have to refer to one of my longer term charts to find a longer term support level that the price may be heading towards, and then I can start doing targets from there. But if the trend and momentum continues in this direction, it looks like I will be playing the S&P 500 short with put verticals on the SPY. Similarly on gold, if the dollar keeps pushing higher and the relationship between gold and the dollar holds, I will also be going short gold through the GLD ETF. Now, what I may end up doing is establishing an underlying position with the ETF, but then stepping in with options on futures to hedge overnight or to manage exposure overnight. Now, I did mention that change in the relationship between the S&P and the 10-year Treasury, and also the break in the relationship with crude oil and the dollar. So what I'll do is take this time to readjust the dashboard. So once again, we'll have the 10-year Treasury lining up with the dollar, and we'll line up gold, stocks, and crude oil, because those three seem to be pushing lower, while gold and the 10-year Treasury seem to be pushing higher. So I'll monitor the relationships, the correlations between the different asset classes, and if any of the relationships strengthen, then I can start taking cues from one market to confirm or repudiate decisions in another market. But until then, I just try to group like things together. Things that are trending higher, I group together. Things that are trending lower, I group together. And then I look at their pair correlation. Now we can move on to the forecast part of the podcast. Looking at the longer term chart of the dollar, it does seem like it broke out of this consolidating range, but there is a downward sloping plane that if the price continues to increase, it would run into at about the 93 level, which in the grand scheme of things probably means another 65 point move on the dollar. And if the dollar can break through that plane, the target from there would be about 96. As a comparison, it closed on Friday at about 92.32. So going forward, I am watching the dollar, looking for breaks higher, because that seems to be the pattern that's developing on a longer term chart. On the 10-year Treasury, it's still using its regression curve ribbon on a longer term chart as resistance. It does seem inevitable now that prices fall on the 10-year Treasury, because the central bank, the Federal Reserve, is talking about unwinding monetary policy. So the 10-year Treasury is still using its regression curve ribbon as resistance, which also looks like a bearish pennant. That signals to me that the 10-year Treasury market is poised for a longer term move lower in prices, which would correspond to rising yields, which makes sense as the central bank is beginning to talking about unwinding accommodation and tightening monetary policy. Now we can move on to the forecast part of the podcast. So looking at longer term charts, we'll start with the dollar. We've seen a pullback in the dollar, a sharp move higher in the last trading week. A lot of that has been around the announcement that the Fed made about their target date for them beginning to unwind monetary accommodation. There is this consensus trade out there that the dollar should be going short, and I was trading counter to that consensus, and I thought that this move higher this week was a confirmation that I was right to be counter the consensus. But looking at my longer term charts, I am conflicted about whether the short dollar consensus trade might be right. It's just a matter of finding the right entry point, because if we have higher than expected inflation and the Fed allows that to persist, then we should see things like gold go higher. We should see things like stocks go higher. We should also see things like oil go higher. But if we're gonna have inflation, which devalues purchasing power and eats away at your real yield, then we shouldn't have foreign investors buying that currency to buy that debt. So the positioning on the 10-year treasury on the longer term chart is a short. It's using its regression curve ribbon as resistance. It looks like it's setting up a bearish pennant, which is a chart pattern. So the idea is to look for a breakout of the pennant, and you use the downward leg leading into the pennant as your measurement for your target after the price breaks out of the pennant. 10-year treasury is pointing to a short. That makes sense from a macro standpoint. A long dollar doesn't, however. A short dollar makes sense in a macro standpoint, especially if you're looking at international capital flows. Yes, the United States has positive nominal yields, but inflation is going to eat away at that and keep real yields negative in the United States. Your fixed income investments are negative when factoring in inflation, compared to an economy that has a negative nominal yield but is also facing deflationary pressures. Because with a negative nominal yield, you're paying someone to hold your money. So you give them $100, they promise to give you back $95. But if you're in a deflationary cycle and prices are falling, as long as when you get back your $95, it's able to purchase the same amount or more stuff than when you first gave them the $100, then your real yield is positive, even though your nominal yield is negative because prices are falling. So, factoring in for deflation, you're actually seeing an increase in the purchasing power or a real return on your investment. So what we should be seeing are currency flows into economies that are facing that issue, like Japan, like the Eurozone. But if we're seeing capital flows into the Eurozone, long euro, then by definition we're looking at a short dollar. So from a macroeconomic standpoint, the short dollar consensus is more rational. We'll see how it plays out in financial markets. How that affects my trading is that going into upcoming trading sessions, I am looking at reversals lower as my base trade, and anything else I need to hedge against. So I'm looking for areas of resistance, short, medium, and long term. And as the price gets to those levels, my intention would be to go short. If I need to, hedge. But if you're also seeing the price breaking through long-term resistance levels, you may just be wrong in your underlying assumption. Because if resistance levels aren't holding, that means the price has the strength to move higher. And then especially if it then reverts back to that price level that it broke and reestablishes an old resistance as a new support, then you're definitely wrong in your underlying assumption and you should be going in the opposite direction. Not trying to hedge, but leaning in the opposite direction. The next thing we'll look at is gold. Gold was sitting above its regression curve ribbon. It was using the lower bound of the ribbon as support. It looks like it's about to retest that. More than likely it holds, because where the price would intersect that ribbon, it would also intersect the 50% level on a Fibonacci extension, which is around $1,700. So gold drops to about 1,700 and finds support. Then we're looking at a move higher. First to about 1,890, 1,900, and then on to about 2,100. If it can hold 1,700 as support. If not, you're looking at a drop down to about 1,575. With the S&P, I think there's a similar pattern. We more than likely see the S&P drop back down to about 4,050 towards the end of the month before it establishes that as support, after which it will more than likely break right through the 78.6 on its Fibonacci extension, which would correspond with about 4,300. Last month, the 4,050 level was tested several times, but the market inevitably closed well above that. Seems like this month we could be making the trek back down to the 4,050 level. If that does hold as support, it will be confirmed as support. And from there, the price is heading to 4,300, which is the 78.6% on its Fibonacci extension. And depending on how much positive economic news is out there, we can see the market move past 43 and onto about 4,600 towards year end. Crude oil is an interesting case. It is on pace to hit its $76 a barrel target. It has been setting up weakness lately. So in the short term, like I mentioned on the dashboard, crude oil is looking like a short. But in the medium to longer term, on my macro charts, it is still looking like a long, pushing towards $76, $77 a barrel. And if it can break through that, then we're easily looking at a target above that of $95 a barrel for crude oil. Now, as a cross-asset correlated market to crude oil, I also like looking at the soft commodities, the grains, and looking at my medium-term charts on corn, wheat, and soybeans. They're all losing momentum. All their regression curve ribbons have reversed. The prices seem to be making lower lows and lower highs on medium-term charts. Linear regression slopes measuring momentum all turn negative. Their linear regression slopes measuring trend are all positive, but getting less positive. So looking at the medium-term charts on my soft commodities, that hints to me that crude oil is also facing some medium-term weakness. Even though on the longer-term charts, crude oil looks like a long. Same thing with the S&P. Longer-term charts looks like a long, but it does seem to be facing some short to medium-term weakness. Gold as well. From looking at the charts, it seems like the S&P may have the most to fall, then oil, then gold. What we could be looking at, because these are longer term chart patterns that are playing out, so in the next couple weeks to wrap up the month of June, we could be seeing these three markets consolidate sideways with a downward bias. because they still need to cover the distance from where they are now to the lower bound limits on the longer term charts before they can consolidate and turn around and move higher. Or we can have a couple really volatile days in the market, a couple big spikes down, levels are tested, and you can start the reversal of the trend almost immediately. Also an option not to be discounted. And on that note, we'll wrap it up. This week you heard me talk a lot about technical indicators, mentioned a couple chart patterns, and some candle patterns as well, all of which fall under the technical analysis umbrella. As an investor, as a trader, it's very important to understand and to have context for what you're seeing in the market. And a good way to do that is to just look at a visual representation of the price. So there's a chart. At first glance, it may look like a jumbled mess, but you start looking for patterns to repeat, and the picture becomes a little bit clearer. It becomes a little bit easier to make money and a little bit easier to spot pitfalls that would cost you money. You can learn to chart, you can learn technical analysis from watching YouTube videos, you can read books, you can listen to podcasts. You're listening to this podcast, you're familiar with the terms that I use. If you would like to learn more about my technical analysis system, you can visit my website at RTN Education. That's rtn.education, EDUCATION in your browser. Hit enter. And it will take you to my website where I have courses available in charting and technical analysis. I will help you understand chart patterns, candle patterns, and technical indicators so that you can make buying and selling decisions. You can also visit my consulting website. That's runthenumbers.biz, RUNTHENUMBERS.biz in your browser. Hit enter. Where I offer services including fine-tuning your investment approach to the economic environment. Because again, no one strategy works in every environment, and the goal is to be a profitable trader, a successful investor. And in order to do that, you need someone to guide you through the changing economic environment, and you need someone to advise you on how those changes can affect your specific investment approach. And on that note, this is your neighborhood financial economist, Katie Mark. When in doubt, take profits.